Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are about to get rich or get rich quick. Today we are diving into Dankon Corporation's latest report, and folks, this one has some interesting numbers. We are looking at their quarterly filing, which gives us a snapshot of how they are doing. Before we dive in, if you like getting the real story behind corporate jargon and financial reports, hit that subscribe button. We break down these complex documents so you don't have to. And hey, if you want to chat about these filings more, join our Discord community. You will find the link in the video description below. This report covers the 3-month period ending the 31st of August of 2025. Now this company is pretty new. They were incorporated in November of 2024. So we are looking at very, very early stage stuff here. Let's jump straight into the balance sheet. Think of this as a snapshot of what the company owns and what it owes at a specific moment. On the asset side, things get a little quirky. They show intangible assets. These are things like patents or software that have value, but you can't touch here. These intangible assets jumped from $45,000 at the end of February to over $80,000 by the end of August. That is a pretty big leap for a new company. What's this real-world impact, you ask? It basically means they are investing in things like their website or software that they expect will bring them value later. Now for the liabilities section, here we see something called loans from related parties. This means money borrowed from people connected to the company, like its owners or executives. These loans shot up from about $13,000 to over $73,000. This tells us the company is relying on its insiders to fund its operations. And then we have stockholders' equity for Dankon Corporation. This is actually a deficit. That means that by the end of August, their total liabilities were more than their total assets. They were in the red by about $15,000. This is not uncommon for brand new ventures, but it is a key piece of the puzzle in understanding their financial health. Let us look at how they performed financially over the 3 and 6 month periods also reported in this filing. This is where we see the actual business activity, the revenues, and the expenses. The revenue number is quite small for both the 3-month and 6-month periods ending the 31st of August 2025. They reported total revenues of just $9,581. This is extremely low and indicates the company is just starting to gain traction or has a very niche offering at this stage. But then you look at total operating expenses, which were $33,223 for the 3 months and $47,000. Owe $25 for the 6 months. This means they are spending significantly more than they are earning. And that leads us straight to the bottom line. For the 3 months ended the 31st of August 2025, their net loss was $23,642. And for the 6-month period, the net loss was a substantial $37,444. This really highlights the early stage nature of the company, where the focus is likely on development and market entry rather than immediate profitability. And the net loss per share, well, it is a loss of 1 cent per share for both periods. Again, very small numbers reflecting the early stage business. Let us examine the statement of changes in stockholders' equity. This details how the equity section of the balance sheet has changed over time. It starts with a deficit of $2,730 at the end of February. Then there is a significant transaction where they issued almost 1 million shares for cash. This brought in $24,675. This is crucial for funding operations. This brought the total equity deficit down to $15,499 by the 31st of August. Despite the new shares, the company still has a negative equity position. Now let us talk cash flow. The statement of cash flows tells us where the money is coming from and where it is going. For the 6 months ended the 31st of August 2025, they used $46,068 in operating activities. This means their normal day-to-day business operations are consuming cash. In terms of investing activities, they spent $39,200, which we saw was for intangible assets. This again points to investment in their platform. Where did the cash come from then? Well, financing activities brought in a much larger sum. They received loans from related parties totaling $60,500, and critically $24,675 from the sale of common stock. This is how they are keeping the lights on. And at the end of the period, their cash balance was a mere $3,482. This is very low and underscores their reliance on external funding. The company describes itself as an online service designed to elevate the art of congratulatory messaging. So they are building a platform for crafting customized messages for various occasions. Their core offering is an API. This is a really important note, the going concern section. It essentially asks if the company can stay in business for the next year. The report states there is substantial doubt about the company's ability to operate as a going concern. This is a red flag. It means that based on their current financial status, their future operations are uncertain. They plan to fund expenses by using their cash on hand and potentially through loans or a private stock offering. Here we find explanations of how they do their accounting. For example, they explain how they recognize revenue when they transfer services to customers, and they are using a set number of API requests for their service. They also mention that by May of 2025, they had capitalized over $84,000 in website and API development costs. This is part of those intangible assets we saw earlier. These costs are being spread out over 5 years. In the capital stock note, we see that they have 75 million shares authorized, and by the 31st of August 2025, they had issued 4,487,000 shares. Interestingly, they only had a par value of $0.001 per S-share, which is very nominal. The majority of the value in the stock comes from the additional paid in capital. This note reiterates the loans from related parties. It mentions that as of the 31st of August, the CEO and sole director had advanced over $73,000 under a loan agreement. This is typical for early stage companies providing crucial funding. Moving on to management's discussion and analysis. This is where the company executives explain their financial situation. They confirm their platform is for generating congratulatory messages, and its primary offering is the Congratulations Generator API launched in June 2025. Their marketing plan is to start online, which makes sense given their digital product. As of the 31st of August 2025, they had no employees under formal agreements. Their operations are managed by their president and CEO, who also serves as secretary, treasurer, and director. This is a very lean founder-driven operation at this point. They reiterate that since they were founded in late 2024, they only have comparative data for the periods ending the 31st of August 2025. This reinforces how new the company is. Here they break down their operating expenses. For the 3 months, total operating expenses were $33,223, including things like marketing services, server lease expense, and development. Almost $10,000 went to marketing alone in that 3-month period. This section reinforces the going concern out. They state they have recurring losses, an accumulated deficit, and continue to use cash. They acknowledge significant additional funding is required. While they expect to generate revenue through pricing plans for their services, they admit their future depends on obtaining financing and successful operations. This section confirms that financing activities were their primary source of cash to offset operational outflows. They summarize their current condition by highlighting the revenue versus net loss and the accumulated deficit, pointing back to the financial statements for details. This part details their internal controls. Management concluded that their disclosure controls and procedures were not effective as of the 31st of August 2025. This means they are not yet confident that all required information is being properly captured and reported in a timely manner. This is another area that needs improvement as they grow. Fortunately, they report no legal proceedings against them. That is always a good sign. And finally, the exhibits list includes certifications from their CEO and CFO, which is standard for these filings. So, what is the story here with Dankon Corporation? Well, this is a classic early stage startup. They have a product, an API for congratulatory messages, and they have generated some initial revenue. However, they are burning through cash at a much faster rate than they are earning it. The going concern note is a significant indicator that they need more funding to survive and grow. Their reliance on related party loans and stock sales for funding is typical, but it also highlights the inherent risk for investors. The lack of employees and the CEO wearing multiple hats also point to a very lean operation. The fact that their disclosure controls are not yet effective suggests they are still building their internal processes. The opportunities are clear if their congratulatory messaging platform gains traction and finds a market. The market for personalized digital communication certainly exists. However, the risks are substantial. They face intense competition in the digital space, and their ability to scale and become profitable is entirely dependent on securing further investment and executing their business plan flawlessly. Right now, the company is firmly in the risky, speculative phase. In conclusion, Dankon Corporation is a very young company with a declared mission and an early product. They are not profitable, and they are burning cash, which is common for startups. Their biggest challenge and immediate need is to secure more funding while demonstrating a path to profitability. Whether they can achieve this remains to be seen, but the current report indicates they are at a very critical juncture. Alright, that is our breakdown of Dankon Corporation's latest filing. What do you think about their early stage approach and their chances for success? Let me know your thoughts in the comments below. If you found this analysis valuable, make sure to hit that like button and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community. The link is in the description for more discussions. Thanks for watching. See you next time.